third module, real estate investing fundamentals. This is going to be going over a lot of the basics that folks will need to do to buy a rental property. But I think it really sets up those investors investing in the syndicated deals to have a baseline knowledge of what is exactly going on the business level of these types of deals, especially for those people who have never owned rental properties. When we first started this community back in 2016, I myself was still on the tail end of my career of buying little rental properties. And on the podcast, we talked a lot about buying remote rental properties at the time. And we had this incubator course for remote rentals, which is mainly for non-accredited investors. Obviously, as you guys know, our investor base and myself matured and we've moved off of this type of investments. A lot of the content that you're going to see in this next module is going to be derived from this content. And a lot of the real estate fundamentals are kind of encapsulated in this particular chart right here. And if you look on the x-axis, which is on the bottom, you have a spectrum of low-end properties and high-end properties. We'll get into the grading system of Class C on the low end, Class A on the high end. As you're following the different dotted lines, you can see how cash flow, headaches, and etc. moves throughout. And it starts to develop some sweet spots, which we'll highlight in this next section. Some other important things to define before we get diving through this is first, CapEx, which is short for capital expenditures. Today, when we value add assets, we'll fix things up and we'll add in a lot of these types of components. This could be like the roof, new sinks, new cabinets, could even be like dishwashers or a driveway asphalt or just slurry sealing the asphalt. So all this is considered capital improvements or CapEx. And each of these improvements have a different serviceable life. Within the incubator program, where there's actually a spreadsheet that we have with a laundry list of all these different improvements that you could do and the serviceable life. And then the costs, obviously the costs you got to account for inflation because this is a rather older spreadsheet, but it just demonstrates the idea that there's a bit of a life cycle cost analysis in each of these, where at the end of the day, when you add up all these things that can break on a house, it comes out to be quite a bit. And which is why when people buy a house to live in, what they don't realize, and I think most people turn a blind eye to, is things are constantly breaking. And they don't realize that money is just going to consumable maintenance on it. And which is just another hidden cost of owning a house, which is why for people starting out, I wouldn't necessarily think that buying a house to live in might be a good idea for most people within our community. But something to think about when you're having rental real estate and you have to account for this in your numbers. The other thing here on the right side is the vacancy turnover. So when you have a tenant move in, you're not going to have your rental property filled up at all times. There's going to be a certain percentage of vacancy, and it's not like you get them out and then you get the next tenant in right away. Especially if you're doing value add, there's going to be a period where the unit is down. That's the turnover period. In large apartments, a good vacancy number might be about 5% to 8%, which if you take the opposite of vacancy, it's occupancy. So that's about 92% occupied. You probably are wondering, why not 95, 100% occupancy? That sounds like a better number. Yeah, traditionally, if your asset is running at 95, 90, or 92% and above, it's a sure sign that your rents are just too low and you need to be pushing it, especially if you're in a value add type of strategy. But how this distills down for the little single family home owner is you may have a full month there where you're not bringing any rent, and you need to account for this in your numbers. This is, again, part of rental property ownership 101. If you own a rental property, a lot of this you understand intuitively, but this is just a review for those people jumping right into syndications and private placements without any rental property experience. So going into the property classes, Class A, B, C, and D. Class A is the nicest stuff. It's newest stuff. It's probably the stuff that's built within the last decade or two. Class B is getting to be a little bit older. I would say when you start to get into the 1980s, that might be on the lower end of Class B. Certainly when you're looking at 1970s, 1960s property, it's probably a Class C asset at that point. And then obviously there are things that are much, much older out there that you would probably call Class D or F. In commercial real estate, these assets just degrade over time. The idea is you don't want to be holding on to an asset too long because they just become functionally obsolete. Now, I think this is maybe a little bit different than single family home residential world, where you can upgrade those properties and sometimes the old feel of an old house gives it character. But with commercial assets, it is just strictly an age thing. Newer is seen as better. But as we've seen on the previous slide, here, there is a sweet spot in not having the latest and greatest property on the Class A side. So very similar grading system, but for neighborhood classes. And I would probably say that this is a little bit more important because the neighborhood you can't really change. Sure, if you have a 300 unit apartment complex and you have a wall around you, you can somewhat affect change pretty effectively within your apartment complex as you start to kick out the riffraff and bump rents up and get a better clientele in there. But especially with single family homes, the neighborhood block is going to be what it is. And it's going to be one of these four categories here. First, the Class A is your most affluent neighborhoods. These are your cool places to live. I think a lot of us live in Class A neighborhoods. They're going to have the best school districts. Unfortunately, this is not where you're going to get the best rent to value ratios. Class B is more your middle class part of town. It's still relatively safe. Class C, now you're starting to get into places that I think not a lot of you would even want to be spending too much time in, even in the daytime. Low to moderate income levels, I would say definitely 20-30% lower than the median income for the MSA is in here. And then Class D, nobody really talks about Class D too much. If it's Class D, you might as well call it Class F or war zone prop areas. So there are certain resources out there. I usually tell people there's Neighborhood Scout if you have a subscription to that. But the free method is just going to the local municipality website, the GIS that they may have either through the police department or the county, and looking up the crime incident map. In your Class C and war zone areas, you're going to have a lot of more violent crime there. In all areas, especially more urban areas, you're going to have all types of crime, but it's going to be more slighted on the petty crime, the vandalism. I'm not saying that assault is good, but it's going to be more on the better areas, whereas you're going to have the much more heinous crimes happening in the lower areas. So if you're just sitting at your computer trying to figure out if it's a B, or C area. This is where I think as an investor, you need to take a little bit of everything with a grain of salt. The syndicator, the broker, the real estate agent, they're all going to be lying to you at the end of the day. What I would say, most of our investors, they enjoy coming to a lot of our events to meet other purely passive accredited investors and get acclimated in the community. We always tend to have this in cool, fun areas like California, Hawaii, Vegas, places where we don't invest. So I always urge people, when they get involved in these types of deals, we tend to do maybe a investor field trip once per year where we go in the field to a Houston or Huntsville. And this way you're able to jump on a tour of one of our existing properties and you can be there. You can smell the air. You can look around the block. And I'll say, this is, let me stick my finger in the air. This is a Class B minus neighborhood. And then once you do that a couple of times, you start to develop your own scoring rubric in your head. And it's a real touch and feel thing, but it's pretty easy once you've done it. And I think that experience is invaluable. And once you do that, you don't have to do it again. Most times when people come on these tours, it gets a little boring after the second property. And people are like, let's just go to the bar and have some dinner. Let's just get out of here. It's hot. Because I think that's the nice thing about investing in apartments. At the end of the day, it's all the same damn thing over and over again. It's just renting out cubes, where that's what's hard about single family homes. They're all very unique and they're all in vastly different neighborhoods. To wrap this up, again, there's no numerical means of determining this as opposed to the property classes, which you would look at the age of the property or the vintage. With neighborhood classes, if you want a quick and dirty rule, I would say I've got a daughter in a class A neighborhood. She might be having her latte and her cappuccino and jogging there, maybe even the evening time too. Class B area, she probably wouldn't be, there. Or maybe I'm just thinking that my daughter's gonna be super bougie. Probably, I'm guessing. But she might go out for an afternoon jog out there, but certainly wouldn't want to be there at nighttime. Class C, my daughter would not probably want to step foot in that area. I personally am used to this stuff, so I go to these places all the time, but I sure as hell don't want to be caught there at nighttime. I've done it before just for kicks. It was like, let's try and freak ourselves out. Me and my partner went, but it was scary there. So we said we would never do that again, other than just driving by and quickly going to the parking lot. Obviously, Class D and F war zone areas is much, much worse. Like Baltimore is a good example of war zone, like where they have those one-way streets. And then if you're an outsider, you drive into town or drive down the wrong cul-de-sac and they blockade behind you and they mug you and they steal your car. Like that would be a war zone. Class C isn't as bad. Like I said, that said, you can make a lot of money in these transitioning areas. In the early days, we would buy a lot of properties in the Class C area. We turn it around, we make a lot of money. But these Class C areas and these Class C tenants are difficult to deal with on that. Actually, that one property that I mentioned that me and my partner wanted to just scare ourselves and we went there at nighttime, that property consistently ran at 80% collections. So the property was essentially 95% occupied, but 15% of everybody just didn't pay, maybe even 20%. So again, 80% collections or economic occupancy takes into account who's actually there, plus who's actually paying their damn rent. So I think most of us are good citizens. We pay our mortgage, we pay our rent on time. But in these types of neighborhoods, that's just not the case. And I can remember like 2012, 2013, when I had my first properties in Birmingham, and I would get all these Walmart money orders. I wasn't wealthy when I was growing up, but we didn't pay things with money orders, but a lot of these folks will. What got me is sometimes it costs money for these mail orders and it takes time. And they would get hit up with all these late fees that sometimes the late fees and the money order fees for these guys was like 10, 20% of the monthly rent. And it just killed me inside. But that's just how some people live. Some people out there, they don't trust banks. So they have those prepaid debit cards that they just use. I think a lot of us, we just see the people around us. And a lot of us are just very fortunate to live in economic circumstances where we are definitely the top 10% or maybe even the 1% in the country. And we fail to see how the majority of America lives. This is a depiction of the locations and the tenant class put on a scale here. The business plan today is we try to find assets in B locations or better, depicted here in the red. Another analogy I use is in football, you have quarterbacks. They always say, get the quarterback with the best arm, because that's just God-gifted talent right there. You can maybe train accuracy. In a way, when you're looking at an investment, you don't have as much influence on the neighborhood as you do the asset. Obviously, we'll get into this here in a little bit. You're value adding the asset, changing out a lot of appliances, paint job, playground equipment, landscaping, power washing. You're changing the facade of that asset and you're improving that. Essentially, you're trying to bump that class of the building a little bit. Sometimes you're putting lipstick on a pig, $5,000 of renovations per unit, which is enough to change out the flooring, not new cabinets, but repainted cabinets, new appliances. You might need to do $10,000 to $20,000 of rehab to bump it from a C grade to a B minus grade. But a lot of the value add projects out there, that scope isn't quite there. And I think the reason being is like sometimes to spend $10,000, $20,000 of renovations per unit isn't going to get you the ROI, which is the bump in rents. Ideally, you buy properties that's already undervalued where even if you did nothing to it, you bump the rents up $150. But if you're going to do renovations to it, do $5,000, $10,000 of renovations, I certainly want to be able to bump that thing up $200, $250 per month. So as I was saying earlier, I think a lot of us are very fortunate to be living in A-class homes. What you have to understand is majority of the people live in this bell curve. And I would probably say today in this dotted line right here, that is centered around Class C homes or apartments. Now, what this green line is showing is what would happen in a theoretical recession, right? Everybody collectively moves downward. And that's why we try to invest in workforce housing. Not only are the rent to value ratios better in that, but if we're just thinking to ourselves, in case of a recession, the A's move down to the B's, move down to the C's, etc. And we're able to catch the majority of the population out there. This is why, if you've noticed the trend, when we first got started, we would buy a lot of crappy Class C assets in Class C areas. We'd fix it up. We'd make a lot of money. But for us as operators, it was a lot of headache dealing with 15 to 20% of tenants who just didn't pay every month. And that's the thankless job, I think, sometimes is like tracking those people down and getting them to pay or partially pay, because you can't really send that stuff in for collections. A lot of these tenants are just not collectible if they start to rack up thousands of dollars of late payments. You got to rely on the court system to get them out, which is, again, why we focus on more red states than blue states to invest in, because we know that we're going to run into a lot of evictions and we're going to need the court system on our side. But as we've moved along, I think in 2019, we really started to focus more on Class B assets, which is a little bit better clientele. That said, you still have the same problems to some extent, non-collections issues. And when you're working with 1970s properties, things always just tend to break. You can do a lot of due diligence, and that due diligence will identify a lot of things that are just always on the verge of breaking, or maybe fine, but they're just going to break later. There's a lot more variables, which is why I think today, and this may change in the future, we try to focus on a little bit better properties, obviously in good areas, but this concept of Class A, because it's new builds, it's newer properties within the last few decades. I guess you would call it 1990s to present vintage, but still workforce housing. So this is different from like your traditional idea of Class A, which I think of like luxury properties, the stuff a lot of you folks would put your kids in their first apartment. If you lived in California, these properties may rent for $2,500 a month. In a place like Alabama, it might rent for $1,500 a month, just to give you a range there. A good example of these Class A luxury properties as rentals, if you've heard of a publicly traded company, Amelie, I think it's spelled AMLI. If you Google them, you'll see the amenities level. They have like bars for the tenants, really cool amenities. It looks like a hotel, but that's not what we're going for as investors. We want to go for more workforce housing. Again, we want to be in somewhat of the heavy part of this bell curve where the majority of people are out there, so we can be hedged in case that there is a recession. That could happen at any point, right? And that's why I say always try to dollar cost average and spread your investments through a period of time, because you never know when a correction will be. I talked a lot about these renovations previously. Pictures speak louder than words. So this was actually from a little 50 unit I had that was a Class C in the upper right hand corner. Yes, it is yellow, and that's pretty common for Class C assets. And then on the bottom right is the renovation. This one, I think we just repainted the cabinets, or maybe we just changed out the doors, but you certainly see the upgrades in the appliances and then the sink hardware and the countertops. Nothing fancy here, right? This is a classic Class C to Class B amenity renovation. I'll take a moment and I'll dispel some other investment strategies that are out there that some people like to do that I think are a little bit more nearsighted. Some people like to buy properties from auctions. However, when you do this, you don't get access to do inspections on the assets. So it's a total crapshoot. You can make a lot, but it's a total crapshoot as an investment. When we go into assets, we have the financials, the P&L, we get a full due diligence team in there, third-party contractors to get in and itemize all the work that needs to be done. And we want to eliminate a lot of the unknowns. Short-term rentals is what a lot of people like to do because long-term rentals just don't hit the rent to value ratios it once did 5, 10 years ago. That said, I would highlight that short-term rentals is a discretionary part of people's spending. When tough times come, people stop going on vacations, and this falls off of that. We saw this very greatly in the COVID pandemic. People weren't able to travel, and your property went dark. There's a lot of amateur landlords out there heating up this space, and I certainly do expect some type of bubble bursting in the short-term rental world. From a political standpoint, especially here in Hawaii, I don't like the fact that you have a lot of absentee owners buying properties here because it just makes it more difficult for people who it's already expensive here in the first place. But from an investment point of view, short-term rentals is, I think, a lot more riskier way of investing. Number three here, as I mentioned earlier, we focus on red states that are much more landlord friendly. We always want to invest in places where the court system is slighted in our favor. I think a lot of us would agree, especially as the landlords. We believe of anti-squatter laws, and if people can't pay, they can't stay. At least that was the value system that I grew up in. You could probably do a huge fishbone diagram and figure all the inputs of what makes a good market, a good place to invest. What we look at a lot is supply and demand dynamics, and population and job growth are the two big ones. But there's not a good way of measuring those two concepts. But what they do feed into is rent growth, which is extremely measurable when there's a lot of data out there. So that's what we key in a lot of our top level due diligence on markets, because also like rent growth is where the rubber meets the road at the end of the day for us as we get into an investment. The last thing we like to do is we like to control our own fate with doing these renovations. This is totally different than the buy, hope, and pray model. The buy, hope, and pray model is what I did when I first started to invest in 2009 to 2015, when I was just buying rental properties. I put good leverage on it and I was cash flowing, and that's great. But there was nothing I was doing to increase the value of that asset. In commercial real estate, the value of the asset is dictated by the net operating income divided by the prevailing cap rate, or what the assets are trading for. You don't have control over the prevailing cap rate. That's just the market. But you do have control over the net operating income, which is the income minus the expenses. And by doing things like as you're seeing in this picture, changing out those appliances, new countertops, we probably increase this unit rent by $150 a month, or almost $2,000 a year. So if you do the math at home with a calculator, $2,000, which was the increase to the bottom line or net operating income, and you divide that by a 5 cap or 0.05. It's a business plan. You take over an asset, and then your occupancy starts to drop as you start to get the riffraff out. 88% might seem low, but that's just relative. Like sometimes we have properties that have dropped in like the 50% range. And yeah, that hurts cash flow in the interim. And yeah, we like cash flow because that's the lifeblood of the asset, but we try to keep as much reserves where we could, if we needed to, just rip the Band-Aid off, drop occupancy, and get moving through the business plan quicker. Like we got a lot of people out this month, and maybe this coincided with a period of slower lease up season, which is there's some seasonality to people tend to move in more in the summertime, but you can see the average rents just pop up from there. And that's where you're making money. So if you're bumping it from 560 to 620 just in the first year of ownership, and so that's a delta of a small $60 per unit on average. This one had 168 units. So you multiply it by that. Obviously, you haven't gone through even, you've only gone through a fraction of the units renovating. This needs to continue on for another few years. But you take that $60 times 168 times 12, and then you divide it by, even to be a conservative, use a cap rate of 6. And that's amount of value you've created in just this first year ownership here. This one actually went really well. We actually were able to get out of this asset in 2.5, 3 years, more than beating the business plan of doubling our money. So some of the basics here, just so you understand some of the vernacular, multifamily apartments can be defined as a few different ways. The first upper left is the garden style. This is the stuff that we try to focus in on because it's typically more of in a suburban area where we try to stay out of the core business district because the rent to value ratios, property values there just don't justify the holds in most cases. And we tend to like these more suburban types of settings where there's a little bit more space for the tenants, a little bit more homely. This really helped out in COVID where people like their space as opposed to being right on top of each other in a high rise or a mid rise type of asset. You're seeing a lot of no more mixed use and they're great, but they're newer assets and they just don't have the rent to value ratios. Right now, the prices are just too high to justify the acquisition. This is how some institutional investment firms will define some of this types of investing. Maybe just review this and just have it in the back of your head as different ways to describe it. And the reason why, like a lot of this information, I think arms you with the baseline level to understand and talk to other purely passive accredited investors and to really set you up to, if you were to join our family office Ohana Mastermind, you'd be able to talk intelligently about these types of investments. Hey, I'm looking at the Class B asset in the Core Plus type of category. I'm not super sold on the value add plan. So if you want to smoke a cigar and look cool when you talk, you got to talk the lingo, right? And that's what we're here to educate. And more specifically on syndicated deals, there is a syndication e-course that we have, which takes most people about 10 to 12 hours to go through. But to just go through some quick reasons why I initially invested in US multifamily, and I think it's still a strong investment class, attractive risk-adjusted returns. And if you're just going by the numbers, relatively low volatility in terms of the vacancy. Vacancy rates, going back to what we consider is 92% is considered full occupancy, because you're always going to have some vacancy there. And if you're reading between the numbers, you're like, okay, if I go by this, it should be 95%. And you're exactly right. What's accounting for that 2 to 3% delta between 92% and 95%? And that, my friend, is the deadbeat rate. That's typically the assumed amount that even in good assets, you're going to have non-collections on. Out of 100 units, you're going to have a couple of units or people partially pay on those. And just that's the name of the game, right? And that's when we say for the little landlord out there, just to know that you're not going to be 100% on your collections. You're always going to have vacancy and non-collections there to some extent. But that's where the nice thing about apartments is like we're working with minute fractions here, as opposed to a lot of the new landlords. They may be wrestling with an eviction and having 2 or 3 months of vacancy that year. And that's more on the scale of 20 to 30% vacancy that they're having. And that's probably more than enough to have them go negative cash flow on that individual single family home. I think what keeps bringing me back to residential real estate is that there's a healthy demand and demographics. The United States population is growing in comparison to some countries like China, Japan. Those populations are very top heavy and dwindling, whereas America continues to grow. But I think if you dig in a little bit deeper, it's the lower middle class that's growing due to immigration. And unfortunately, things are getting harder for majority of Americans. The rich are getting richer. And I think that's what all of us are trying to do here, right? Invest our money in good assets so that we become that 1%. But again, from majority of Americans out there, it's tough. They're not able to invest in assets like this, nor do they have any leftover after paycheck to paycheck. One of the great things about America is we do immigration, and they typically start living in these types of apartments. I think one of our goals is to provide good quality value living conditions for people out there and treat them fairly and fix things when they break and provide it at a fair price. Getting back to the demographics, looks very strong. Data supports this, that the majority of people in the future aren't going to be living in single family homes. That American dream has gone by the wayside. And where are they going to live? In smaller quarters. And that essentially, imagine that bell curve coming back to the little apartment. You're seeing this trend in majority portions of the world, Asia and Europe. People are moving into smaller square footage living conditions. Now, I'm not saying we're going to get to micro units, people living in 300, 400 square feet apartments in my lifetime on average, but it's moving in that direction. And maybe I saw this when I put on that Apple Vision Pro for the first time. I'm like, first of all, that's an amazing product. Super, super cool. I would highly recommend just demoing it at an Apple store. It's free, but I think it'll change your life. I'm not going to ruin it for you. You're going to see it for yourself. After that, I was walking home and I told my wife, oh my goodness, people are just going to be single and live by themselves and put this Vision Pro on their face and live in their 300 square foot apartments. That's how we're getting to. I'm not going to get people started on like how the next generation are just totally inept at having social conversations. I think that's the way we're trending, and they're going to live in little apartments. Another reason, favorable regulatory environment. The United States has a good court system for the most part, as long as you stay out of California. This kind of helps us. Yeah, there are some municipalities out there that put rent control in, but again, we try to avoid those types of markets. Some people say, why don't you guys do Section 8? I've done it before. I've done it on the single family home side. And then we've done some properties where we've had the property has transitioned from low income to unrestricted rents. And some other properties have 20% of the rents restricted to like about 80% of what the going rates are. I would say if you look at our business plan, we're usually trying to bump the rents and get out before the asset gets really old. So that's typically under 5-10 years. So when you're doing that, you want the ability to bump the rents up unrestricted. And part of that is if you have a low income property, your property is always going to be considered that rough property in the neighborhood. Maybe not necessarily where the shoes are hanging from the power lines to denote that this is where you get your drugs from, but there's always a stigma with these lower income properties. In my opinion, when you get above 20% of your tenants are Section H voucher people, that strategy may work more in single family homes because you can be the crappiest house or tenant profile in that block. And that's actually good for you. But when you're in apartments where you can create your own micro community, having more than that threshold, even 10% of the people being Section 8 voucher, you bring down the tenant profile of the entire community. And a lot of tenants just don't want to be in that. Another reason why I like this asset class is there's a lot of data on this. It's not like laundromats or car washes, which, goodness, I've been hearing about this stuff for years. I'm tired of hearing about those stupid things. I think it's a bit of a bubble, personally. Everybody's getting into it. That's a part-time entrepreneur or beginning entrepreneur getting into that stuff. Whereas again, that's why I like real estate, because real estate, you need money to get involved in this type of stuff. And maybe one of the bad things about real estate is there's nothing really game changing coming on the horizon. But as far as like data and statistics, which we use to derive a lot of our underwriting off of, it's pretty solid. We'll use Yardi or CoStar, which investors don't have access to. It costs like $20,000 plus for these subscriptions, but this will have very key information on the rent growth, the rents at the current time, and competition and comps. And you pair this with this high degree of transparency of census data, demographics, median income, you realize why a lot of these institutional investment firms from Wall Street like to invest in this stuff. And also the life insurance companies that back a lot of our infinite banking and credit investor banking policies invest in this very same asset class in the same, very similar way. There are other asset classes within the real estate sector: office, retail, industrial, hotel. There's even mobile home parks and self-storage, which I'm not a huge fan on. Like, one of the nice things about multifamily, it's one of the bigger asset classes, and thus it's a very liquid type of sector where we always test the market. Even though we're not ready to sell the asset, the business plan isn't complete, maybe we'll just submit it to some brokers and it'll become an off-market property because we're not super serious about selling it. And we'll get a bunch of offers. And if we really wanted to do the full-blown marketing package and putting it out on the street, we might get like 40 to 60 offers on an asset when you call for offers. So incredibly liquid sector. And everybody is, I think, sold on the whole what I was discussing about multifamily and the long-term prospects of it. And then I think that's where I'm guilty of this. I put out a lot of content and information on the weekly newsletter, and a lot of it is I'm trying to be like a media company and trying to scare people so that they pay attention. But if you're like myself, who doesn't really get excited about too many things these days, and like, what is the one that just happened recently? It's election season, so there's a bunch of crap going back and forth in terms of rumors. The latest thing is like some type of bill in place to restrict rent bumps more than 5%, and it's put everybody more on the Republican side in arms. And the media is just trying to draw day trade attention, like how they always do. But this happened a few years prior when Congress had this bill where they were going to get rid of the self-directed IRA and blow all that up, and it never happened. I've been in the game for 15 years with this stuff, been watching it. You start to get really tired, and although I'm not from an age-wise old, I've got a lot of mileage. And I've just seen a lot of this news and things that are supposed to get people excited or triggered. And I just try to look past that, all that noise out there in the media and in terms of business plans or investments out there. Another good example that kind of went by the wayside several years ago was like cannabis investing. Everybody was looking at that as a new emerging asset class. And that's why I'm like, I don't even want to look at car washes and laundromats. Goodness gracious. I think that's just a thing that sells YouTube video attention for people who don't really have too much money, who can't really afford apartments or these type of asset classes. But I guess getting back on topic, focus on trends that are going to be around for a decade plus. Don't look at the small crap that's going to be 1 5 year trends. What is the stuff that's going to be around time tested? And I had Peter Linneman, the podcast, a few times, and this is exactly where he comes from. Avoid the noise, the stuff that moves quickly. Real estate is one of those things, especially apartments, that you're looking at the long-term demographics and the demand is going to be there. And there is a fundamental shortage on this stuff. That's something that is really predictable yet boring, and a good place where people can feel safe to put a good portion of their net worth in. Sure, maybe you want to go into more asymmetric plays, but at least have that as a baseline on your investment. Invest in things where the trend long term is in your favor. Another reason you have a good amount of leverage options. This kind of pivoted a little bit or it got paused in 2022 when interest rates got jacked up, and it hurt all industries. But the loan to values came down from 75% on average down to maybe in the 50% range. The leverage was one good thing about multifamily. It got put on pause in recent history, but long term, I think you'll start to see this come back because a lot of the institutions they invest more for the long term and they see the value of it. And also what got me into this asset class initially, or at least into apartments going from single family homes, is I realized that the government knows that they have a workforce housing shortage for the lower middle class and and lower class, but they're not in the business of building government housing. We have that, but it's not on the scale like how other Asian countries do it. And for good reason, because that's how you create projects in the bad sense, like in New York, right? The really rough areas. And it becomes a cesspool for crime. Ideally, what they've discovered with more modern urban planning practices is that you want to spread out your lower middle class, your working class out in the suburban, or just basically spread them out, right? So they're not all pooled in one area. But that's where it becomes very difficult for the government to implement that. And one of the only ways that they've been able to do this is offer good financing through the government-backed agencies of Fannie Mae and Freddie Mac to give to people like us to use these semi-government-backed loans at great rates. So the way I looked at it, see where the money is flowing and put yourself in position to catch it. Another reason as far as diversified credit risk, but like when you have an apartment with 200 individual tenants, you have 200 people that are all going through different things in life, but for the most part, you're not concentrated with just one anchor tenant. In contrast, you have a strip mall. You might have a dozen tenants in there, Safeway might be your anchor tenant. You don't have that many tenants in there. So if one leaves, you might now be down 10% in terms of occupancy, where multifamily assets have a large volume of leases, which is a nice thing. Transparently, I also say, though, the downside of this is, yeah, you might have a lot of individual tenants and that provides diversification, but individually, they are all regular people. This is where industrial properties and commercial properties like strip malls might have a leg up because you're renting out to not regular people who has a flat tire with their car and now they're late on their rent. In the other example I was giving, it's more commercial tenants. So they have thriving businesses and you underwrite the business as the ability to pay the rent. Whereas in residential real estate, you're underwriting individual people using credit scores. You verify their pay stubs so that they're hitting that 1/3. You don't want more than 1/3 of their paycheck going to their rent. And you're doing your criminal and background checks. And that's pretty much the standard vetting process to getting good tenants. As I've seen many times, especially firsthand as a single family home investor, people are people and they run on tough times, and especially people who have less money. And I've maybe when I owned single family homes, I maybe had a dozen of these evictions, and a few of those times these guys will just trash the property. We certainly have that share of it in the apartment world. The nice thing about the apartments is they can only mess up the inside of the property, whereas the house, they got a lot of more surface area, literally, for them to jack up, and they got a lot more square footage on that too. So your exposure on that is a lot more. The range of damage that they can cause on an apartment is a lot less than a single family home. These guys, they all run on tough times, and that's just part of the business. That's why you shouldn't be running a property at 100% occupancy and economic occupancy. This is why you want to have a large unit count to help. Every month you're going to have a handful of tenants run on tough times. Another good thing about the apartment world is you have shorter term leases. So like the most leases last about a year, whereas office, industrial, and other real commercial retail investments, they typically last on a 5-year or more cycle. So with us being on a year cycle, we're able to adjust for inflation a lot more quickly and pass costs down to tenants. And this gets into maybe a little bit political, but like the whole idea of inflation typically gets passed down to the consumers who have the least ability to account for it. And this is a good example of it. Like we mentioned earlier, we like to try and eliminate risks. We pull the financials, we underwrite it. We send in the full due diligence team to itemize major components, like, for example, the individual HVAC, the roof, and create a list of CapEx. And we're able to forecast and build a prescriptive plan of what deferred maintenance items need to get done, as in addition revenue generating CapEx items that we can be doing. And this can be accurately forecasted pretty well. And then of course you apply a layer of buffer contingency. And then reason 10, in apartment investing world, you have a lot of good third-party leasing and property management options. They're extremely plentiful out there. If somebody is not performing, we'll get something better out there. There's not a loss for options out there, put it that way, in terms of property management companies. The opposite of that is mobile home parks. There's very few, if any, major property management companies that specialize in that sector. So oftentimes the mobile home park operator, they really need to get their hands dirty and do it themselves, or find somebody who actually lives in that park to be a pseudo property management person. And they need to get lucky doing that. So that provides a level of competition for us to be able to change out property management if things don't go the way we want. But with that, that's the end of the real estate fundamentals section. I think that was a good high level of understanding the business of real estate. Nothing replaces experience and actually investing in deals and seeing what happens. But I think the good step on this is to go check out that syndication e-course and to dig more into that content there. There's maybe about 10 to 12 hours of content in there that kind of builds upon this fundamentals and talks more about doing due diligence on syndicated deals.